Welcome to The Explainer. Today we're looking at why the smartest money in decentralized finance, literally the capital powering multi-billion-dollar systems, might actually be leaving serious cash on the table. We're going to dig into some cutting-edge research to understand exactly how the mechanics of these platforms are currently flawed, and much more importantly, how we can fix them. So let's dive right into this. Right now, there are billions of dollars locked up in liquidity pools all across the blockchain ecosystem. These pools are the very engines of decentralized trading. But what if the providers of that massive capital are heavily misallocated? What if they're taking on totally unnecessary risk for suboptimal rewards?
Well, some recent empirical research looking at on-chain data just uncovered a pretty shocking truth about the current state of DeFi. Liquidity providers, the absolute backbone of these automated markets, are frequently earning lower returns than if they simply staked their assets passively. Imagine doing all the heavy lifting of market making, taking on the daily risk of price volatility, and still earning less than the blockchain's baseline risk-free rate. Today, we're going to break this down by logically stepping through the liquidity provider problem, when stablecoins break, the math of mean reversion, the layer 2 advantage, optimizing capital allocation, and finally, the future of DeFi. Starting with Section 1, the liquidity provider problem. Let's look at why these participants are the vital backbone of DeFi. You know how automated market makers, or AMMs, work. They swap out traditional order books for smart contract reserves and mathematical conservation curves. But here's the kicker: the generic math powering these AMMs has a massive blind spot when it comes to natively pricing different types of assets on the blockchain. Which brings us to Section 2, when stablecoins break. We need to talk about the one-size-fits-all flaw. Here is the core issue. Standard AMMs use a universal math curve for literally everything. They treat highly volatile cryptos, the ones jumping all over the place with extreme trends, exactly the same as pegged assets, stablecoins, which are specifically designed to oscillate tightly around a fixed peg like the US dollar. Using the exact same mathematical model for a wild asset like Bitcoin as you do for a stable one like USDC, that is a recipe for massive inefficiency. And why does that matter? Because even the most rock-solid stablecoins sometimes break. Temporary periods of depegging are just inevitable. We saw this back in 2023 with USDC during the exogenous shock of the Silicon Valley Bank bankruptcy. When those depegging events hit, standard AMM models completely fall apart because they aren't built to handle an asset that's naturally supposed to revert back to a specific price. They just blindly follow the market down, totally destroying the liquidity provider's capital along the way. So how do we fix it? Section 3, the math of mean reversion. This is the rubber band solution. To solve this stablecoin problem, financial researchers are proposing we replace standard AMM models with something called a multi-level nested Ornstein-Uhlenbeck process. Now, don't worry, you don't need a PhD in stochastic calculus to get this. Just think of the math like a giant rubber band. When its stablecoin depegs and the price stretches away from its target, this new math accounts for the tension that's naturally pulling that price back to its long-term mean. The crucial takeaway here is that this advanced math stops the AMM from handing out terrible quotes to arbitrageurs during a crisis. It essentially mitigates that exaggerated confidence in a fixed peg, acknowledging that, hey, the asset will eventually snap back. And doing this safely protects the liquidity provider's capital, even if that depegging phase lasts a while.
But flawed math? That's only half the story. Let's look at Section 4, the Layer 2 advantage, where we tackle the network problem.
Because the second huge inefficiency dragging down your yields has nothing to do with complex pricing curves. It's actually about physical blockchain network congestion. Picture the Ethereum mainnet as a super crowded room. Everyone wants to be in there, right? So you end up with way too many liquidity providers splitting the exact same pie. And since trading fees are distributed proportionally, this massive oversaturation dilutes returns down to a really meager 3.03% for some highly liquid pools. I mean, think about that. That's actually lower than just the basic passive ETH staking rate. On the flip side, faster Layer 2 networks like Optimism, Arbitrum, or Base, they act more like VIP rooms. Transaction fees there are a fraction of a cent, so traders have totally migrated their volume over. This means you've got fewer liquidity providers sharing a much bigger pie of trading fees. The result? A staggering 22.12% return for the exact same token pairing. It's wild. You can literally see this disparity in the empirical data. Take a look at Ethereum at the top. Massive total value locked at over $219 million, but a tiny 3.03% return. Now look at the layer 2s right below it. Arbitrum is delivering over 13%, Base is up over 17%, and Optimism. It has a tiny TVL of just over $6 million, but because traders are actively using it, it's generating a massive 22.12% return. It just perfectly highlights that Ethereum pools are massively, massively oversubscribed. Let's move right into Section 5 to see how this builds into a real strategy, optimizing capital allocation. Using a concept called Lagrangian optimization, researchers proved that you can absolutely maximize your yield just by acting rationally across these different networks. It really breaks down into 3 simple steps. First, check the baseline risk-free ETH staking rate. If a pool pays less than that, get your money out. Second, evaluate those individual Layer 2 pool yields. And third, reallocate your capital away from the congested Ethereum mainnet and into those high-yield Layer 2s.
The long-term effect of doing this is actually really fascinating. The math shows that as liquidity providers smartly reallocate their capital following that exact logic, returns across networks aren't going to stay skewed forever. As capital floods into Layer 2s, those yields will naturally compress. Eventually, in a perfect equilibrium, the returns across all decentralized exchanges on all networks will balance out and converge exactly with that base staking rate.
So let's pull all of this together in Section 6, the future of DeFi and optimizing the ecosystem. Look, the future of decentralized finance isn't just throwing money into random liquidity pools and hoping for the best anymore. The smartest money is going to operate in a highly optimized future. That means tossing out those old one-size-fits-all models. It means AMMs are going to implement that nested Ornstein-Hohenbeck mean reversion math we talked about, specifically to protect pegged assets. It means capitalizing on the speed of Layer 2 environments. And finally, continuously reallocating capital based on strict Lagrangian optimization to just constantly chase the best risk-adjusted yield. Which leaves us with one final, absolutely vital question to consider. We've seen the math, we've seen the data. As this multi-billion-dollar system rapidly matures and all these hidden inefficiencies get squeezed out, which side of the equation will your capital be on? Are you going to be the one optimizing the system or the one being optimized? Thanks for joining me for this explainer, and remember to always keep questioning the mechanics behind the yield.